Okay, let's dive right into this explainer and unpack the absolutely massive quarter Bloom Energy just reported. We're going to be looking directly at the numbers, specifically from an investor's perspective. Now, if you've been following the monumental shift in global power demand, driven heavily by artificial intelligence, you know that infrastructure is the new bottleneck, right? It's literally holding everything up. So today, we're breaking down exactly how Bloom Energy is positioning itself as the critical valve to release that bottleneck. But before we even map out our route, we have to talk about this insane milestone. Bloom just hit over $1 billion in quarterly revenue for the very first time. Just to put that into perspective for you, their CEO, KR Sridhar, mentioned that it took Bloom 21 years to deliver its first billion-dollar year back in 2022. And now, they're crossing that exact same threshold in a single quarter. I mean, that is a massive signal to the market that their business model is rapidly accelerating and significantly expanding their true enterprise value. So here is how we'll structure our analysis today. We'll start with the Q2 earnings beat, then move into the AI power catalyst, explore their competitive moat, look at scaling financial leverage, and wrap up with their forward guidance and outlook. All right, Section 1, the Q2 earnings beat and how they surpassed Wall Street expectations. Look at the sheer magnitude of this beat. Wall Street was expecting $827 million in revenue. Bloom delivered $1.065 billion. That's a staggering 166% growth year over year. And on the profitability side, analysts modeled earnings per share at 41 cents, but Bloom came in at 78 cents. They nearly doubled the estimates. From an investment standpoint, we aren't just looking at a company edging past targets here. We're looking at a company fundamentally accelerating past them, essentially rewriting the financial models most analysts have been relying on. When we break down that billion-dollar quarter, we see that nearly 90% was driven directly by product revenue, coming in at $935 million. That is up 215% year over year. And this tells us a really critical story. This isn't just some recurring maintenance revenue propping up an aging fleet. No, this is massive, fresh deployment of new technology. It reflects a severe acceleration in data center deliveries that's feeding straight into their top-line expansion. Moving on to Section 2, the AI power catalyst and how they're paving the way for data centers. This quote from the CEO brilliantly illustrates the core thesis right now. Time to power is really time to token revenue. So what does that actually mean for the bottom line? Well, Sridhar explained that a full-stack AI provider running a 1 gigawatt data center can generate between $12 and $24 billion in revenue per year. Think about that for a second. If those chips are just sitting in a warehouse without power, they aren't generating intelligence. They're just incredibly expensive inventory. For these tech giants, pulling in power by just 1 month early can mean capturing an extra $1 to $2 billion in revenue. Suddenly paying a premium for fast power isn't just a cost. It's a massive, high-yield revenue enabler. This exact urgency is what builds a massive advantage for Bloom. Let's contrast the traditional grid's years-long delays with Bloom's execution. Legacy power suppliers are out here currently celebrating backlogs stretching all the way to 2029. But Bloom's management rightfully pointed out that a 4-year backlog isn't a trophy, right? It's a confession of constrained supply. Meanwhile, Bloom can deliver reliable, islanded, on-site power in a matter of months. When the business case for artificial intelligence is measured in months, the fastest, dependable path to power is ultimately going to win the contract. Let's dive into Section 3, the competitive moat, and how Bloom is removing friction for their customers. Bloom systematically removes friction across 4 key areas. First is capital, which we are going to look at deeply in just a second. Second is community. Bloom servers don't use combustion. They have negligible air pollution and minimal water use. Communities simply will not accept new massive combustion engines in their backyards right now, making Bloom incredibly attractive. Third is permitting. Because of that clean profile we just talked about, customers get air permits vastly faster than they ever would with traditional turbines. And fourth is speed. Their supply chain is built around broadly available materials from multiple countries, and their tech is deployed like Lego blocks. If you remove these 4 frictions, you naturally become the supplier of choice. In fact, all major U.S. hyperscalers have now officially validated and approved their technology. For any investor holding the stock, that is a massive de-risking milestone. And this perfectly illustrates the capital solution we just mentioned. End customers often want to pay for power over time rather than dropping billions upfront on equipment. So Bloom brings in the financiers. Last fall, Brookfield Infrastructure Partners created a $5 billion financing shelf. They watched Bloom execute, they evaluated the pipeline, And in just 9 months, they expanded their commitment by 500%, up to $25 billion. Capital of this quality doesn't follow press releases. It follows bankable, performing assets. Furthermore, Brookfield isn't flying solo here. A syndicate of heavy-hitting financial institutions, including IDF, Oaktree, MUFG Bank, and Morgan Stanley, has committed another $2.6 billion to fund Bloom deployments. This absolutely proves the institutional bankability of Bloom's model. As an investor, when you see gigawatts of demand backed by gigadollars of advanced capital commitments, that heavily de-risks the company's growth runway and validates their entire financial ecosystem.
Okay, Section 4, Scaling Financial Leverage, looking at margins and profitability.
So the absolutely crucial point for investors here is structural operating leverage. While revenue grew by 166%, operating expenses grew by just 48%. Their R&D and general and administrative base is largely fixed at this point. They're using automation and analytics to run their support functions exactly like they run their factories. Because of this setup, every single incremental gigawatt of delivery carries very little overhead, driving pure profitability straight to the bottom line. This is exactly the kind of scalable margin expansion that sophisticated investors are always on the hunt for.
And the story of their service margins is just a remarkable turnaround. Let's look back to their IPO 8 years ago. Service margins were sitting at a negative 21%, and analysts were highly critical of it. Fast forward to Q2 2026, and those service margins are now sitting at a positive 22%. That is a massive 43% swing. Overcoming historical service losses fundamentally changes their enterprise value and proves the technology's long-term robustness and extended stack life out in the real world.
When we step back and look at the total financial health for Q2, it's pretty exceptional. Non-GAAP gross margins expanded over 600 basis points year-over-year to 34.3%. Operating income hit $240 million. They generated $226 million in operating cash flow, and they are currently sitting on a $2.7 billion war chest of cash. When you combine those expanding margins with hundreds of millions in free cash flow, the financial foundation to support true hypergrowth looks incredibly solid. Let's look at Section 5. Forward guidance and outlook, projecting out for 2026. Management aggressively raised their full-year revenue outlook to a range of $3.9 to $4.2 billion. At the midpoint, that represents a 100% growth rate over their 2025 revenue. And importantly, they made sure to note that their guidance is built bottoms up. It's based on signed backlog conversions and actual customer site readiness dates, which means they have extraordinarily high conviction in this trajectory. They aren't just guessing here. They are calculating based on real contracts in hand. And circling back to that profitability, full-year operating income guidance was raised to between $800 and $900 million. What's absolutely vital to note here is that this operating income guidance practically doubled from the start of the year. It perfectly illustrates that structural operating leverage we just discussed. Revenue is scaling massively while costs are staying tightly controlled, bringing them to an expected 21% operating margin for the year. As we wrap up this explainer, I want to leave you with this final thought. If time to power is truly the ultimate bottleneck for the entire artificial intelligence revolution, and the legacy grid is fundamentally incapable of moving at AI speed, just how massive is the runway for a company that can actually deliver it? We've seen their margins improve, their financing skyrocket, and their backlog burst. Bloom Energy isn't just selling generators anymore. They are selling the speed required to win the AI race. Thanks so much for joining me on this deep dive, and definitely keep an eye on how these fundamental advantages continue to play out in the quarters ahead.